Okay, let's take a look at how we would do a perpetual inventory record for a last in, first out. Remember, with last in, first out, we're assuming that when we sell something, we're selling the most recently purchased or the last items that came into our inventory. Again, people find this weird because they wonder why you would do that. And like I said, some businesses um, have business models where they sell newer products really before they sell or first or more often, I guess, than they sell older products. The most common example are technology products where people want the newest, hottest item rather than the older versions. Anyway, so let's get started with this. So we can see this is the Montour company, and we see that they had a beginning inventory of 540 units on January 10th. So we'll start by entering that into our record. There was no purchase and nothing sold. This is just the units they had at the beginning of the month. So 540 units at a cost of $55 per unit means that they had $29,700 in inventory. January 1st, sorry, at January 1st. Then on February 10th, they made a purchase. So they purchased 460 units at $53 per unit. So now their inventory will be the 540 units that they already, 540 units that they already had, plus the 460 units that they just purchased. So there's their inventory now at the end of February 10th. If you've already done first in, first out, you'll notice that this process of purchases is identical. It's only when we get to units sold where it's going to look different. Okay, so on March 13th, whoops, I can't type. They purchased 100 units at 40. So now we'll see that their inventory is all the units they had plus the ones they just purchased. So there's their inventory as of March 13th. So now we're going to get to where this is different from first in, first out, because we're going to get to their first sale on March 15th. And they sold 745 units. And our question, as always, is which units did they sell? So what we're going to do is we're going to assume these newest units, the ones most recently purchased, are the first ones to sell. So if they sold 745 units, I'll say, okay, they sold all 100 of the $40 units. And they sold 460, all 460 of the $53 units. So that's 560, meaning, let's see, 745 minus 560. Can't do that math in my head. So they sold 185 of the $55 units. So with last in, first out, we assume they sold all of these and all of these plus 185 of these to add up to the total units sold of 745. So there's our cost of goods sold. And then our remaining units are going to be 540 minus 185, or 355 of the $55 units. Okay, so all we're really doing is we're saying we're going to assume when they sell stuff that it is the newest units that they're selling, the ones that they most recently purchased. That's it. All right, August 21st, they have a purchase of 170 units at a cost of $61 per unit. So now they'll have 355 of the $55 units, and they'll have 170 of the $61 units. And then on September 5th, they had a purchase of 430 units at a cost of $54 per unit. So now their inventory will sit at the units they had plus the ones they purchased. And now we'll see their sale on September 10th. So on September 10th, they sold 600 units. And so again, which 600? So we're going to assume it's the oldest, or I mean the newest, the most recently purchased. Okay, so all of the $54 units and all of the $61 units. So 430 plus 170 should give us 600. So there's our cost of goods sold. And we should be left with all 355 of the $55 units. And there we go. So as of September 10th, they have $19,525 worth of inventory. And their total cost of goods sold will just be the sum of all of the cost of goods sold. $72,145. If we wanted to find their gross profit for these transactions, we would just have to take the revenue. Remember, revenue is the number of units sold times the sales price per unit, and we know we sold them for $80 per unit. So it'll just be 745 units times the sales price of 80 plus 600 units times the sales price of 80. So the revenue is 107,600. Cost of goods sold, we just figured out right here. So our gross profit is our revenue minus our cost of goods sold. And there we go. So there's our perpetual inventory record using last in, first out. You'll notice it gives you a different gross profit than if you use first in, first out, even though really you sold the same number of units. The difference is the assumption of which units you sold. Under first in, first out, we assumed we sold the oldest, or the oldest units, the ones that were purchased first. That's what we assumed. And under last in, first out, we assumed that we sold the newest units, or the ones purchased most recently. So I hope that helps, and I hope you have a great day.